Our first guests on the program, we have Jahangir Aziz, Global Head of EM Economics at JPMorgan. We have Arvind Sanger, Managing Partner at Geosphere Capital Management. Gentlemen, great to have both of you here. Thank you very much for your time. Jahangir, let me start with you. You know, markets, of course, want the best of everything, right? Higher expenditure, continued expenditure in investment, infrastructure, something for the mass consumption sectors, and of course, no compression in expenditure. The thing is, I mean, they could actually do it because of higher tax revenues and the RBI dividend as well. So just, I mean, set this up for us, Jahangir, in terms of how you're looking at it. Will this be a pro-growth budget?
Sure. So let's start with the starting point, right? So the starting point is last year's budget deficit. It was supposed to have been 5.8%. It turned out to be 5.6%. So you get 0.2% off the bat as carryover revenue from last year that was not spent. Then you add the 0.4% of GDP of higher RBI revenue that was transferred to the budget. And then if you look at tax revenues, tax revenues grew at 13.5% last year on a 9.5% nominal GDP. In the interim budget, the assumption was about 11.5%. So even if they hold on to the interim budget 11.5% growth rate, because you're starting from a higher base, you're automatically going to get a larger revenue. So clearly there is a significant amount of revenue space that has been generated both because of last year's more austere budget as well as the transfers from RBI. And the question therefore is, what will they do with it? Our sense is that they're going to stick to 5.1. So remember, it was 5.8 to 5.1% in the interim budget. It is going to be 5.6 to 5.1, so it's a much easier task. But more than that, of that 0.5% of consolidation that they will have to do, 0.4% of GDP already comes from the RBI. So as far as the economy is concerned, the drag on the economy is barely going to be noticeable at 0.1% of GDP.
Fair point. Okay, good evening, Arvind. Welcome to the show, you as well. As a foreign investor, what do you want to hear? What you definitely don't want to hear today?
Well, we certainly want to hear about pro-infrastructure spending. And we certainly want to hear about tax simplification, as you were talking about earlier in your program, capital gains and other taxes, just simplifying that structure. Obviously, if the government does rationalize and the individual taxes, because of the 10-year no movement in the bracket, so there's been a bracket creep, if I may call it that, in terms of the minimum exclusion, that will also help in terms of consumption. So all of those would be pro-growth. What would be, not pro-growth is if they were to increase taxes on capital gains. That would be regressive from a market standpoint. And I guess the question is what kind of transfer payments, because it's clear from the last election that there's going to be some pressure on the government in terms of either giving more to specific states, or more in terms of subsidies or other benefits to rural India. And again, I don't think we're opposed to some of those measures which might come about, but we still want to see, as Jahangir was just saying, that 5.1 target either stay there or maybe even improve a little bit, which I think there's some room given the higher tax collection. So, the RBI dividend gives them some room, and there's room from the higher tax collection, which should allow for, I wouldn't call it a dream budget in terms of, but at least a pro-growth and also a pro-consumer budget without busting, the balance sheet.
Pro-growth, pro-consumer, lower taxes. I mean, if all of that comes through, it'll definitely be a dream budget. Arvind, Jahangir, good morning, and thanks for taking the time out and speaking to us. We were talking about a fall in the fiscal deficit, right, Arvind? And India has by and large been a darling of global investors. If we do get a fall in the fiscal deficit number, if the target is met, and perhaps, as Latha was talking about, the possibility of rating agencies upgrading India as well, do you think that will spur the animal spirits further? Because now the problem is that a lot of the good news perhaps has been priced into the Indian markets. What do you think could keep the market going here on?
Well, look, 5.1%. First of all, let me say at the outset, I'm not a big believer that budgets are the make or break of what's going to drive the markets or the economy going forward. Budgets are just an interim step in that. I think that the real issue is, what is the economy going to do and what is the government going to do to facilitate it? So in my opinion, some rationalization of taxes and some increase in capex, because the interim budget only showed a 10-11% increase in capex. We think those are the two most important things that the government can do to continue to unleash animal spirits as far as both consumer spending is concerned, and as far as business confidence to be able to, one of the things that has been missing, to be perfectly honest, in terms of a big engine for the next level of growth, has been private capex. So obviously, there are things like the PLI scheme that are helping, but I think we just need to see more of that, and therefore, staying focused on the things that the government can do to enable that is important. One thing that we haven't talked about is, what is the government going to do about the public sector? And unfortunately, I think it's unfortunate that the public sector see the privatization or disinvestment seems to have fallen off the table. I would like to see that reemerge, but I don't know if that's hoping for too much.
Arvind, you mentioned taxes, but did you mean taxation on the capital market side? Because I think that has become the big chatter, because it got a mention, especially the F&O segment got a mention in the economic survey as well. Before that, you had the SEBI chief, the RBI governor, in different contexts talking about flows into capital markets, etc. So just a quick word there, Arvind.
I was talking more about individual taxes. I'm not hoping for any negative surprises.
I thought so. But on capital market taxation, nothing, right? I mean, you're not expecting anything. That's not the base case at all.
I don't think so.
Okay. Jahangir, there's one argument that the government has more money because of the RBI dividend, which is a one-off really, because of high returns on their FX from US treasuries, etc. So that should be used only for fiscal deficit reduction, because if you put it on programs, how will you get the repeat money? Then there is the other school of thought which says that consumption is weak. I mean, we've got to do when we can. Which way would you lean?
So look, there's always a balance between the two of them. It is clearly the case that you need to have consolidation. You talk about, this budget being 5.1%, let's say it's 5.1%. You got about 3.2, 3.3% of state deficit. That puts India right at the 8.5, 8.6, 8.7% level of combined deficit. At 10% growth rate, with a target of bringing down this 5.1% to 4.5% in the next fiscal year. Even if that is possible, you need about a 10% nominal GDP growth rate just to keep debt at the current level of 81, 82% of GDP. So clearly there is a need to bring down these high levels of fiscal deficit. But on the other hand, as you said, look, this economy is still about 5 percentage points below its pre-pandemic path. It has been running basically on two engines, public infrastructure and services export. The other parts of the economy haven't fired. Yeah. And therefore, there's a need to make sure that consolidation is balanced. Now, we keep talking about, weak consumption. Where is the weak consumption? Consumption grew exactly what real incomes grew. Last year, nominal GDP grew at 9.6%. If we assume that household income and corporate income shares did not change, I think I haven't seen the KLEM data, which has some data on wages, but I haven't seen that. But assume that the two haven't changed, then I'm going to assume that incomes also grew at 9.6%. You have 5.5% inflation. That gives you real income growth at 4%. Consumers' real consumption grew at 4%. Where is the puzzle? The puzzle is that why did real income did not grow at the level at which the official GDP number is? That's a different problem altogether. Consumption did exactly what it was supposed to do. Real income grew at 4, consumption grew at 4. So I don't understand, why should we be boosting consumption? You boost consumption when consumption is growing less than what it should be growing at, which means that precautionary savings are going up because of uncertainty or some other reason. Then you do something on the fiscal side and the policy side. But Indian consumers are doing exactly what the real income growth is telling them to do.
Okay, fair point. That's one way of looking at it. I mean, the overall numbers, GDP 8% and consumption 4%. That was one way of looking at it. But take your point. I mean, all this will be debated. Arvind and Jahangir, thank you very much for sitting up for us. We hope when you wake up tomorrow, at least there won't be any tax tangles. Thank you very much for joining us.
Thank you.